When I was working with John Leocani and Vince on this program, we thought it would be a great idea to do, to talk about the CFO role within a portfolio company owned by a private equity firm. We did this presentation 2 years ago, but it wasn't private equity focused. It was focused primarily just on the family owned and or privately owned business. And so we've gotten feedback from some of the people in this group as well as clients over the years and others, and they said, why don't you do this just focused on the role of the CFO in the private equity firm. And as a search consultant, we see subtle differences, and they do vary by private equity firms. So we thought it would be best approach to put together a panel today, and I'm going to let them introduce themselves in a second here, but we thought a good mixture would be two private equity firms, well-known private equity firms, well-respected private equity firms, and that's FEI Capital and Winchurch, as well as have a CFO that we actually placed with a portfolio company of a private equity firm, and then Rob Stettner. So, and then the other reason is if you look at the composition of the middle market these days, in the last 10 or 15 years, the growth of private equity ownership in that space has grown exponentially. So if you think about your career, and you think about where you're headed in your next job, or you're already in a private equity firm environments, it's really important to understand what is going on in that world from a career planning point of view, or just from an educational point of view to become more aware. So we put together this panel today. We're going to discuss about a lot of different aspects about the role of the CFO and technical aspects, the skill sets, the interpersonal skills, the communication protocols, the politics sometimes, as well as the employment agreements and compensation packages that sort of differ from, or may differ from, the private sector that we always hear about. So we want to kick off the meeting though with a 5 to 10 minute overview of what is going on in the private equity world. So we're going to have both private equity firms start off, and Patrick, well, before we do that, why don't we just go right across the room and do our 2-minute introductions, and then we'll get into that.
Sure.
Patrick, you want to jump?
Yeah, absolutely. Thanks, Bob. Good morning, everybody. As Bob said, my name is Patrick Jensen, and I work for a firm called FEI Capital here in Chicago. We're a private equity fund focused on the lower end of the middle market. And maybe just a little backdrop on myself. I've spent 17 years in the transactional space, 15 years of those on the investment banking side, of working with family-owned entrepreneurial businesses and private equity-owned businesses, predominantly exiting or selling the business. I was with a firm called Duff & Phelps here in Chicago for the last 12 of those 15 years on the investment banking side. So I worked alongside the management teams and specifically the CFOs during that process, and a lot of those situations resulted in selling to private equity. For the last 2 years, I've been with FEI Capital. Like I said, we're a private equity fund here in Chicago. We're investing out of our 5th fund. We've made 83 platform investments since we started in '97. And our target market is businesses, we call the lower end of the middle market, but businesses with kind of 15 to 20 million of revenue up to about 100 million. Earnings or EBITDA of kind of 4 to 12. So that's the market segment that we really focus in on. And we are targeting to be that first institutional capital coming into a situation. So we're buying or we're partnering with a founder, an entrepreneur, a family of going through that first transition. And we're really industry agnostic. We do transactions across a lot of different industry verticals, but it's really specific on trying to find that right partnership. So that's a brief background on kind of my transactional background and kind of where I sit at FEI Capital.
Thank you, Patrick. My name is Tom McGonigal. I'm the Chief Financial Officer of the Penray Companies. The Penray Companies are a $35 million manufacturer of aerosol and liquid products. We have locations here in the Chicago area in Elk Grove Village and up in Wheeling. We are owned by a firm called Source Capital based in Atlanta. I've been with Penray for 3.5 years. Source Capital has owned Penray for 4 years. So I got there about 5-6 months after the acquisition took place. Prior to that, for 2 years, I was the Chief Financial Officer of a company called PLZ. It was another manufacturer of aerosol products. So I've been in the aerosol industry for the last 11 years. They didn't tell me 11 years ago it was somewhat like the Hotel California, where you can check out anytime you like, but you can never leave. Once you're in, you're in. I started my career with Coopers and Lybrand back in the 80s. I worked for Coopers for 9 years, and then during the 90s for 10 years I worked for a German-owned company. I was the CFO of the U.S. operation of a company called MWP Inc. based in Stuttgart.
Good morning, everyone. I'm Rob Stetner. I'm an audit partner with McGladrey. McGladrey is a traditional CPA firm. We're the 5th largest in the country, 5th or 6th in the world, depending on which publication and which day you look at those reportings. But inside McGladrey, we focus on private equity to a great extent. About 23–24% of our total firm's revenues is generated through private equity services, audit, tax, and consulting. On the audit side, it's almost 25% of our firm's revenues. So it's a significant focus of our firm. About 90% of our firm focuses on privately held businesses. Very different than what I would say the Big Four typically focus on. About 10% of our client base is SEC registrants. So we have a very, very strong focus in the privately held business area. Obviously inside of that is private equity. I've been with the firm about 23 years, and so I've been working in private equity since the very early 2000s, 2001 or so. So my viewpoint is such that.
Steve.
Thank you. My name is Steve Wellborn. I'm Managing Director with Winchurch Capital, actually right across the street. A very convenient location, appreciate that. Been with the firm for about 6 years. I'm actually a finance professional with operations experience. Started out in banking, commercial lending, real estate lending, a little bit of investment banking. I got my MBA and I wanted to try the corporate finance side, so I moved with Southwestern Bell at the time, which is now AT&T. Did FP&A and strategic planning and M&A work, and wanted to get some operating experience, so I moved out to one of the wireless operations as the Director of Finance. Was then promoted to the CFO of all the wireless properties up here in the Ameritech region, 5 states, about a $4 billion operation. They were grooming me to do other things, so I also was the head of consumer marketing for 3 years. I was also the head of sales and operations for 3 years. You know, all the while envisioning how I could use all this checkered past or multidisciplinary background, and found my way right into private equity. I took an early retirement. I was a CFO, so I've been in the shoes here. I'm now on the private equity side as a sponsor, and my role is primarily on the portfolio side, working with the CEOs and CFOs to make sure that we understand that value creation model. My background, I've got gray hair, scars on my back, so I can interact pretty well with the folks out in the portfolio companies. Winchurch is a value-oriented, operationally focused private equity firm. We too, like Patrick, focus in the middle market, 50 to 500 million in sales. Sweet spot's probably 100 to 200 million in sales. From a strategy standpoint, we tend to invest in underperforming or lesser performing companies, also known as turnarounds. We partner with management to focus on that operational turnaround plan. From an industry standpoint, we tend to focus on industrial and manufacturing companies. Sectors include aerospace and defense, automotive, building products, energy, etc. So we too are agnostic. Headquartered here in Chicago, 24 professionals. Also have an office in Detroit, and then a origination office in Toronto. About 2.3 billion in assets under management. So look forward to discussing today. The topic I think is very relevant.
Another thing that's relevant to our discussion today on the CFO role is just give a background of how the private equity world has evolved, and if you can bring us up to date talking about doing your market update. Patrick, maybe you could start and you can talk about anything but like valuations, the competitive landscape, how it's really changed since 2008 when the market crashed, what the future looks like, anything you would like to discuss that would give the audience a feel for what's going on in the private equity world. And we understand it's very diverse.
Yeah, it's very diverse, and I tell people I can give the market update 30 seconds, or 3 seconds, 30 seconds, 30 minutes, so I'll try and kind of be brief here. But you know, where we sit on the private equity side, and you know, I guess it's kind of nice that you know, I get to go first, so Steve, I'm sure you're going to have a viewpoint too on this. You know, we're in the market of looking to deploy our capital in opportunities that we find attractive. But we're also in the market of selling our portfolio companies. So we're a buyer and we're a seller. And when you look at kind of today's marketplace, it's a pretty frothy market. And I think it's more of a seller's market than a buyer's market. And I'll kind of walk through why that is. But if you look at just kind of overall transaction volume this year, it's been a tremendous year in terms of deal volume, and valuations are up dramatically, over the last couple of years once we've kind of rebounded from the recession. And really, you kind of have to look at a bunch of different factors of what's driving valuations. And each situation is, I think, case specific, but there are definitely market situations or market drivers that are impacting valuation. So I kind of first start with the debt markets. The debt capital markets right now are about as frothy as they were in 2007. And that's in terms of the abundance of capital, the willingness that the bank and the non-bank financing sources are willing to lend money to borrowers, to creditors, at leverage multiples that mirror what they were kind of pre-recession, which is somewhat eerie and scary because we all know how that kind of ended. And the pricing and the terms on those deals are very aggressive. So the cost of capital from a debt side, because when we finance our transaction, when we purchase our companies, we're putting typically anywhere from 40 to 50% equity in, but we're borrowing a significant portion of that purchase price. And just the terms that we're getting from the financing sources are allowing us to put more leverage on the businesses and get cheaper cost of capital, which is driving up pricing. So it's a circular conversation, but you start off with the debt markets. There's a definite abundance of capital out there, both from traditional banks, and then there's several non-bank financing sources, funds similar to private equity that focus in on the debt side. And then if you move down balance sheet from an equity standpoint, you can probably attest to this, it's a competitive marketplace. Private equity is somewhat of a commodity these days. And if you look at maybe just some statistics, since 2008, there's been $650 billion raised in private equity. That was from 2009 to 2013. Over 878 funds, so the average fund was about 740 million. In 06 and 07, you already had an overhang of equity capital in the marketplace, and so more money has been allocated to this asset class, which is attractive because it provides your businesses out there opportunity to get capital. But what it's done is it's lowered kind of the return requirements and thresholds on the equity side, given the fact that it's a competitive landscape. So for us to kind of participate in a process, you are competing against a number of private equity funds that are willing to put maybe more dollars to work or be more aggressive on a specific asset, which is driving prices up. The third thing to kind of look at from a valuation standpoint is the strategic buyer marketplace. And I'd like to hear kind of your viewpoint on this, Tom. The strategic buyers right now are well heeled. I mean, these are publicly traded and privately owned businesses, non-private equity owned businesses that their balance sheets are good, they've got cash, and they've got to show growth. A lot of these publicly traded businesses have kind of flatlined in terms of the public markets, and the one way to show the street growth is through acquisitions. And these groups have formalized and dedicated corporate development departments, business development teams to go out and find either acquisitions or JVs. So they're part of the competitive fold for acquisitions. And then lastly, the way I look at it is just company performance over the last year or 2 years has been pretty good. When we look at our portfolio at Prairie, we currently have 21 companies in our portfolio, and year over year, our revenue's up about 8 or 9% in aggregate, and our margin profile, our EBITDA margin profile, has been consistent. So what that does is that basically tells the marketplace, i.e. buyers, private equity, and strategic, that you've got a consistent asset, a growing asset that's going to get more traction from the financing market and the equity market. So it is kind of a circular conversation of what's driving transactions, but that's kind of the backdrop of what we're seeing in the marketplace. The private equity landscape, like I said, has gotten a lot more competitive, and that's because there's been more dollars funneled in. We've seen kind of offshoots of various private equity funds. We're investing out of our fifth fund. There's lots of groups that are starting out their first fund or second fund out there, and so just the number of funds has expanded. And the last thing that we've seen a lot of is there's a growing rise of these independent sponsors or fundless sponsors out there. There's groups that are acting like they are private equity funds, but they don't have committed capital behind them, and they get transactions signed up, and they're looking for deal flow too. So it's a competitive situation of funded and non-funded private equity funds out there looking for essentially the same types of transactions.
Well, we didn't compare notes, but almost verbatim, I'm going to reiterate much of much of what Patrick said. I mean, the headline is it's a frothy market. And for firms like ours, it becomes challenging to find opportunities. Our average multiple of EBITDA that we paid for the first 3 funds, we're in our 4th fund, just raised our 4th fund, is about 4.6 times. Multiples today, as Patrick said, are 8, 9, 10, 11, 12 times for some businesses. So it makes it challenging. And why is it frothy? Well, obviously we're all familiar with the Fed's accommodative policy. There's a lot of cash in the market, tremendous liquidity. Too many dollars chasing too few goods, as we know from Econ 101, results in higher prices. We see that today in terms of multiples that we're expected to pay. Every Monday morning we have our review of our deals, and we'll talk about a deal. We'll say, yeah, go do an IOI and throw a 4 to 5 or 5 to 6 or whatever the number is. Next week report out. How did we do? Well, we missed by 2 turns, so we didn't get the management meeting. So what we're finding in this market, competition is fierce, more than we've seen in a lot of years. That being said, there are bad operators at all times, which for us is a good thing. That's where our deals tend to come from. They tend to come from good companies who are poorly managed, or they tend to come from corporate carve-outs, big companies who have a little piece of business that aren't of interest to them, but that we, with the right management team, can create value. And so despite the really frothy market, we're still finding opportunities. That said, we are net sellers as well. We're either selling businesses that are peaky or toppy in terms of where they are in the industry cycle. Auto's a good example. We have a lot of auto exposure. We think you got another 1 or 2 years of running auto, but we're starting. We don't want to time the market. You'll hear the bell ring. We're going to start to monetize those investments. At the same time, there's some trophy stuff that we're looking at, be it in mining or ag or some of the other businesses that have cycled down hard from the recession, and perhaps the next year or 2 are way up. Oil is another example. We think within the next 6 months, there will be tremendous opportunities. Unfortunately, this collapse in oil price is going to hurt a lot of businesses. That for us is opportunistic, and so we'll find hopefully deals there. So good news is there's always opportunity out there. We're kind of an all-weather fund. We do a lot of turnaround, deep distress, but we also do opportunistic challenges as well. What we find, therefore, is the key to private equity, successful private equity, is having a disciplined approach to investing, sticking to that disciplined approach. Know what you know and know what you don't know. Stick to your knitting. Firms that get in trouble and don't make it to that next fundraiser, ones who tend to swing outside the strike zone, they get a little more money in the next fund and therefore have to put it to work and start doing things they really don't understand. So we think successful private equity funds will need to really stick to their disciplined methodology of investing. If so, you don't overpay, you don't overlever, you can still make money in this space. The landscape has changed over the years, much more competitive, many more challengers as we heard, and competitors. But again, I think the key is really sticking to your knitting, finding those investment opportunities that have value-creating opportunities, getting the right CEO and CFO and COO in place, and that's where we'll kind of tie all this together, and making sure you have a value construction model and value construction plan on how you're going to create value for the investment.
Rob, we're going to ask you to, since you touch a lot of private equity firms as well as a lot of portfolio companies, and you forgot to add something on your role. Didn't you get recently promoted in the last year? You're the assurance partner in charge of private equity for the firm. Is that correct?
That's right. That was 2011.
Oh, okay, 3 years ago. It's dated. Anyway, but to that
details.
So how time flies. But to that point, what are you seeing? And a couple questions. Like, first of all, of the total middle market, how much of it is now owned by private equity? Just roughly. I don't even know if you know that. You mentioned 25% of McGladry's volume is private equity, but right. What of the total volume of privately held? And that's one thing. And what else are you seeing that complemented or maybe differed a little, or was a different angle from what
Sure.
Steve and Patrick had to say?
Yeah, no, clearly what I would say is our transaction advisors, our group that does the financial and the IT and the tax diligence, they're extremely busy. Last year we thought it was a busy year. The year prior we thought it was a busy year with the fiscal cliff. This year is busier than last year, and it continues to be busy just looking for the add-ons and the platforms. And so to what these folks have said, the deal flow and the activity is high. What I will say to support the valuation discussion we just had is I see a lot of goodwill in the books. When we close a deal, goodwill's higher this year than it was last year. It's higher than it was 2 years ago. So the multiples are high, the valuations are high, and so is goodwill. So that clearly, from my point of view, it does support what we're hearing today.
Okay. Well, now we're going to jump right into the questions, and unless anybody has any questions about just what's going on in the private equity? Dan?
So from a financing side, are the regulatory guidelines for the banks, have you seen more of the financing being pushed to the bank finance companies?
You know, I think that's definitely impacted some banks, depending on how well capitalized they are. I would say over the last few years, we've seen more non-bank entrants, and so those are either private funds or public BDCs, business development companies, that will provide not only senior, but maybe all the way down through junior capital, so they'll provide what is called a one-stop. And that's become kind of more commonplace, I think, in the marketplace the last couple of years, and they've gotten very aggressive on leverage multiples. Their cost of capital is a little different than the banks, but when we look at it from a standpoint of a traditional transaction that we would enter in, would be there would be some form of senior debt, some form of outside sub debt, and then there would be our equity. And so we'd have to look at kind of that blended cost of that senior and sub. What the unitranche or one-stop providers provide is kind of a blended rate, and typically that overall leverage is more on a combined basis than what you would get separately from your senior and sub debt lenders. So I think we see more and more non-bank financing sources trying to get in. At Prairie, we have a very conservative approach on leverage, which is why we probably lose out on a lot of opportunities to our brethren in the marketplace. We don't want to be in a situation where we have a great company and a bad balance sheet. And I know we get presented projections and everything looks like this, but we know from the types of businesses that we invest in, founder family entrepreneurs, there's typically a J-curve phenomenon in the deals that we do, because there's an investment required on building out the team, building out the C-level, maybe making some investments in the sales force or operationally. And so we don't want to be hamstrung with a bad balance sheet. That's just our opinion, but the debt's out there for sure.
I would concur in that unitranche model, which probably is only a couple of years old, is very, very aggressive today. Looking at, not regular, we like Prairie. You've got two fairly conservative Midwestern firms here represented, which may or may not represent, the coastal private equity firms, but we too are fairly conservative. We would rather over-equitize. The deals we do are fairly hairy, and so we would rather over-equitize on the front end. But then we can load up with the debt. That debt may be unitranche, similar levels of debt. But we're also looking at the high yield market today for some dividend recaps. It's essentially, it's not only asset light. There are no, not on covenant light. There are no essential covenants. Now there's requirements for early prepayment. But I think to answer the question, capital in the debt market is just as pervasive as it is in the equity market. It's chasing the same fewer deals.
Is there still a lot of cash on the sidelines as there was a few years ago?
Yeah, I would say there's probably more cash on the sidelines. I mean, definitely from an equity standpoint. And one thing I didn't mention is I talked about all the capital that was raised kind of post-recession. Well, there was a ton of capital, and I've got some slides. I'm happy to send them to you for follow-up data on this. But just thinking through this, there was a ton of private equity funds that were raised in 05, 06, 07. And these funds were raised, and the recession hit. And when these funds were raised, these groups were pretty conservative in terms of trying to find opportunities to invest. But a fund has a 10-year life. So the time's ticking in terms of deploying that capital. So the first 3 or 4 years, that fund maybe sat on the sideline and said, you know what, I don't like this deal for valuation purposes, or I was pretty conservative. And then the recession hit, and that basically deal flow shut down for a couple of years. So now they're 5 years into their fund, and they haven't deployed, they haven't put their money out at the required pace. So then they're in catch-up mode over the last few years, and they're getting very aggressive just to put the money out to get to that next fund. So, I mean, that's a phenomenon that we've seen, is that overhang from pre-recession and then all the money that kind of poured in post-recession. There's a lot of capital. We wish we were more net sellers of our portfolio right now.
Yeah, and we're in a similar situation. We're trying to do the same, and it kind of depends on where you are in the cycle. We have a lot of vintage 06, 07 stuff that rode through the recession, and we were patient, and now we did the heavy lifting and took out the costs, and now we're seeing some growth, so we too are trying to capitalize and monetize on that. But clearly there's a tremendous amount of cash still on the sidelines, and that's why the multiples continue to be chased up.
Well, that's very, very helpful. Another question?
Just one quick question. What is your philosophy about buying and selling between each other versus finding companies that are direct sellers? In other words, some firms sell to each other
Yeah.
back and forth.
Well, that's a good question. So when we exit, we look to traditional strategic buyers, but also financial buyers. So I would say we sell 50% of our portfolio companies to financial buyers, i.e. private equity firms or some combination thereof. And the other 50% is probably to strategics. Strategics look at it perhaps differently than the equity folks might. They can come in and they can take out some of the costs if there's some synergies there, and so they may pay a different number than a private equity. But I think in our case it's almost 50-50.
Yeah, I would concur on the exit. Back to what Steve mentioned before, I think which is critical for a successful private equity fund is focus. And so focusing, whether that's the industry or if you're more focused on kind of a turnaround situation, our focus is being that first institutional capital going into an opportunity. So founder, family, entrepreneur. That's our market. If it's owned by another private equity fund, it's a quick no for us. We're not set up to trade cards with them in terms of taking their asset off. There's lots of funds out there that do that. That's just not an area where we focus and really kind of board our concentration efforts on.
But that's a good point. I didn't say it. We tend not to buy from private equity funds either, unless they're distressed situations, which again fits our model and our discipline of investing. Because again, private equity folks have a different perspective. So that's a good point, Patrick.
Yeah, and I don't want the audience to read into that because it's a valuation arbitrage situation. Because in today's marketplace, whether you're buying from a private owner or a private equity fund, I think the valuations are relatively pretty consistent. Owners are pretty sophisticated and pretty knowledgeable about where the market is from valuation. It's not like it was 10 years ago when there was a big spread in terms of what you potentially could buy a business for. You can't, quote, steal a deal in today's marketplace, even if you have a proprietary situation where you developed a relationship with the company. I mean, you're going to pay a fair market value for that business. And so what we really try to do is develop spend the time and energy in developing a relationship with that owner and that team to determine if that's somebody that we want to spend time with and it's a good team or we can be helpful. And if you buy a business through an auction process, and I did this for 15 years and sold over 50 companies, you get maybe 1 or 2 dates with management before you have to determine we're going to march down the aisle and we're going to buy that company. So it's just a whole different philosophy of how you approach. So our focus is trying to find that situation where we can develop a relationship with that founder, family, entrepreneur.
Well, now we're going to move to the role. That was a very good backdrop to what we're going to be talking about now. We're going to jump in and talk about the role of the CFO, and I'm not necessarily going to go in order of some of these questions that we sort of bounced around between each other, but I'm going to start off with a very fundamental question, and I'm going to aim it at Rob and Tom. But since Tom, you haven't spoke yet, we're going to give you the first crack at this. Is one of the questions that's on everybody's mind is how does a CFO role differ between a non-private equity owned company and just a privately held company? What are the similarities and what are the differences that you found? And we understand it's just your perspective and there's others out there, but what have you found, Tom?
Well, what I found working in public accounting is that, I have a controller and he's very good. He does a very good job. You pull together the numbers, and every month we'll do a 75 to 85 page or slide PowerPoint presentation. We have monthly ops meetings and we have quarterly board meetings, and we just put a lot of work, a lot of effort into it. He does a really good job of helping prepare those slides and pull all the information together. The CFO, we have looked at 7 deals in the last 2.5 years. And we're 0 for 7, which is even worse than my college batting average. Every so often I would get a hit, but we are losing out on the acquisitions because you try to identify what the synergies are, and as a role of like the CFO, we'll go in and say, okay, what are the synergies? We're trying to buy a company that can use or sells what we make. So we're making automotive and heavy-duty diesel products. And so we're looking for companies who can use or who sell those products. And we looked at a company about 2 years ago that sold what we made, and they would buy their products for about $20 a case. We would make it for $14. So it was a lot of synergy we felt if we were to acquire them. And then So on the purchasing side, we look at synergy. On the organizational side, we look at synergy as well. And the CFO of a private equity owned company can really add value, I think, if you look at what the synergies are and how you identify those synergies, because then it affects what price you're going to pay for those companies. At my German company, we weren't really looking to buy companies. It was, there wasn't as much of a sense of urgency in that, 3 to 5, 5 to 6 years, and we're going to be out with the private equity owned company. The German company, we were just, we were selling products, and it was kind of different in that respect. But it's just a different philosophy. There's more of a sense of urgency working for a private equity owned company. We have been owned now for 4 years, and are we going to be sold in 2015? No. Are we going to be sold in 2016? Yeah, probably a 50-50 shot. By the end of 2017, are we going to be sold? Almost for sure, because by then it'll be 7 years, and we'll probably be out by then. So, we're working obviously very hard at getting our EBITDA up, so the multiples will get to a higher level. But the controller is more hands-on, doing the numbers, getting the information together, and the CFO is more strategic in that I get involved in virtually every aspect of our business. And it's not just limited to accounting or just the banking relationship, but what can we do to take cost out of our company? We just did a 3PL about 2 months ago, and we hope to save about 10 to 15% of our freight cost by working with the 3PL versus doing the stuff ourselves. And we just we're looking at a lot of CapEx now because we haven't been real successful in buying a target company. But we're looking at a lot of CapEx, so what can we do to, take labor cost out of our plant, or, what can we do to grow the business and just keep the same labor that we have and use more, CapEx. So there's it's a different mindset between the CFO and the controller. And again, I've got a great controller. He does a really good job, but he kind of does what he does, and the CFO is more looking at, okay, what is the total plan? We've been here 4 years. We probably got another couple years or so. What can we do to increase EBITDA and hopefully get a higher multiple when we go to sell the company?
Rob, do you want to address the question again? How does the CFO role differ between a private equity-owned company, the CFO at the portfolio level, and then just your normal, everyday, privately held or even family-owned company? What are the subtle differences, and maybe where are they the same as well? And come from the assurance or audit side or public accounting side.
Sure. I will certainly agree with what Tom said. What I would say is the CFO of a private equity owned business should not be the project manager for the audit and tax engagement. You have to have depth inside that department, a great controller to manage that audit, manage that tax process. That controller needs to be the project manager. What I see is the difference for the CFO inside private equity and a CFO inside what I would say a traditional family-owned business is that CFO needs to understand things differently inside private equity than family-owned, particularly in valuations, fair value accounting, stock-based compensation, mergers and acquisitions in terms of integration, IT impact, things like that, trying to understand, okay, if I buy this deal, what does that mean? If I take on this debt load, is it convertible debt? Is it subordinated debt? Does it have warrants? Typically those complex debt and equity structures don't exist inside family businesses. So those CFOs inside private equity need to be that much more technical and that much more involved with the nuances of accounting today that probably really didn't exist inside those businesses 5 or 10 years ago.
I'm going to jump over to the role about expectations regarding communications, both informal and formal. So, and these two questions are aimed at Steve and Patrick. So in other words, what are your expectations on an informal basis? The formal would be your weekly or your monthly or your quarterly reporting. What are your expectations? The informal ones are you know, when something's really, when there's a problem, there's an issue, or there's a big opportunity, you know, what's the protocol? And that's where I use the term the politics. When does the CFO go to the president, and when does he go directly to the private equity ownership? So, Patrick, you're smiling, so I'm going to let you tackle this one first.
It's funny because as I was thinking about this, we look at the role of CFO, and we'll get into kind of some of the attributes of that. But to your last comment, CFO reports to CEO, but there's a dotted line to the board. And so we want to make sure, from our standpoint, that it's a two-way street where we've got a good relationship with that CFO. I think one of the things that I think any private equity fund doesn't want is any surprises. And so to your kind of communication, yeah, there's the daily flash or weekly flash, there's quarterly package with KPIs, there's, you know, quarterly board meetings, audits and budgets and all that stuff. That's all formal, that's all check the box. But, you know, it really depends on what's going on with the business. But we really want to be that sounding board for that CFO. And so whether we're talking to them multiple times that week, maybe it's once a week, it kind of comes and goes, but we want to have a direct line, almost a backbone with that CFO, so we can understand and have a pulse of what's going on specifically with the cost side, because that CFO has got to own the cost side of the P&L. And the better CFOs own the cost side and also understand and don't get kind of hoodwinked by the sales guys on the revenue side. And so we're going to talk about kind of what makes one CFO better than the other a little later, but that's definitely an area where we really focus. And then it's managing kind of banking relationships and whatnot. So yeah, that's my take.
Yeah, no, I agree. We view the CFO as the steward of our capital, and so we have that same dotted line reporting into the board as well. You know, in my role, having been out there, I've actually maybe a little more involved, and so my opportunity is to create my role as a resource for both the CEO and the CFO. I want them to be able to call me whenever they want to. Raise your hand if there's a problem. Let us know, because we'd rather know it sooner so we can come up with a countermeasure plan and fix it. But as the steward of our capital, obviously, successful CEOs, or CFOs, I'm sorry, are more than just controllers and numbers guys and bean counters. They got to understand where they add value in the value chain. And the successful ones to us, and we'll talk a little bit more about this, kind of get that, and they understand that they need to view themselves as strategic partners with not just the CEO, but also peers to the side, the other C-level suite, as well as the rest of the organization down. And the more you can create yourself in the middle as a resource for 360 degrees, turning data into information so the business can make better business decisions, whether it's in sales or marketing or finance or ops or HR. That's the real role, we think, of a good CFO. We tend to hire the CEO and then work with the CEO to hire the CFO, as opposed to some firms, not better or worse, right or wrong, who kind of put their own teams in there. Our thought is, if we hire the CEO and everybody below him, how can we hold him accountable for his actions? So we work with him, and we suggest to him the skill sets that are necessary of the CFO and the COO. But at the end of the day, we just hire the CEO and then work with him to hire his leadership team and surround him with that team so they can make better business decisions.
Well, Steve, your answers segue perfectly into the next question, as well as Patrick's. What are those skills and attributes and areas of expertise that you look for if you're part of that process? And we know you're part of the process, because when we've done search firms, that portfolio CEO will say, okay, here's the final interview round, and it's with the board, or it's with the private equity owners, and they'll be the final ones. But when you think of skills, attributes, expertise, what are you looking for? For instance, Patrick just said we look for that guy who can be operational and take cost out of the business. And then we also heard from Tom saying, or Rob saying, they need to be able to understand deal structure and the balance sheet, because it's more complex than your typical privately held company that doesn't have these layers. So, Steve, you want to?
Yeah, I mean, clearly the CFO has to have the technical skills and the accounting skills and communication skills. But what we think differentiates a good CFO, he has to have leadership skills. And leadership skills are really more about behaviors. What behaviors do you exhibit that are consistent with successful leadership? And they're things like setting expectations and objectives that are clearly understood and well communicated with the team. once you set those expectations, you hold yourself and your team accountable, owning those expectations and owning the results, so accountability being the second. The third is building inspection processes to inspect what you expect. That's the metrics and the measurements and the milestones, so you know how you're doing along the value creation roadmap. Having reward and recognition systems so behaviors that are consistent with developing those reward and recognition systems, such that everybody's aligned and toward that same true north of value creation. And then also understanding you have to be able to have countermeasures, and you have to raise your hand when there's a problem. So behaviors that recognize a problem and come to sponsors not with just the problem, but here's the solution, here's the plan, and then work with us so we understand that. So we think that the differentiators, sure, you've got to have the technical skills are kind of the ante in the game, but the winner of the game, we think, are the folks that have those leadership skills that can take that role of CFO, again, up to a strategic level as a strategic partner in the value creation model.
Yeah, I mean, I would echo 100% that. I mean, we look for our CFOs to think strategically and to be operationally focused. But when we're evaluating CFO candidates in terms of the attributes and skill sets, highly technical, that's a given. But from a communication standpoint, what's their history on building their own team? Because a lot of times when we're investing in our businesses, that finance function is understaffed. And so to properly staff it, like Tom mentioned, of having a controller and having support people underneath so the CFO can do the job that we're looking for that CFO to do, and not just get us raw data and then have us interpret it, because we're not the operators of that business, is critical. So their history of kind of building out teams is something that we take a lot of attention to detail to. And then secondarily, I mean, understanding kind of capital markets and just involvement in M&A. Not every deal that we do, we're going to do an add-on acquisition, but in most situations, we are going to look at one or two. And the role that the CFO can play in that can drive a ton of value of looking at synergies, modeling it out, and then also looking at a kind of pre and post deal from an integration standpoint. So those are the things that we kind of, when we evaluate candidates side by side, the ones that separate themselves from the other ones.
When we look at it, just a question back there.
Just quickly, when you acquire a new company, what percentage of the time are you bringing in a new CFO?
I know this specifically because we just had our annual partners meeting right before Thanksgiving, and we give a bunch of stats. 65% on CFO. In any C-level position, it's over 75%. So whether that's CEO, CFO, but CFO usually 65%. Of the last two funds.
Ours is probably similar, if not a little higher, because again, we're buying companies that have kind of struggled, so in many cases it's not the right leadership team. So 2/3 to 70%, yeah.
Now, a deeper question with respect to that, are some of them bowing out before you even call the question, or are they being asked to leave by yourselves?
That's a good question. I think, during our diligence process before we actually close the transaction, we get a lot of exposure, and we try to give people kind of the benefit of the doubt. I mean, buying a company, as a CFO, your role is double duty. When you're going through a transaction process, you've got your daily job, but then you're also running point in terms of being that kind of funnel of information for that buyer. So it's a pretty stressful time for the CFO. So we don't like to make kind of rash decisions of kind of sliding them out. I think what we typically see is from a family founder owner business, that CFO has been with that business for a long time, and whether they're slotted to be that CFO, that may not be the right role, but there's a role for them on the team, given kind of the institutional knowledge they have of the business, the relationship, the culture. So typically, they're involved in some form of the business post-close, and maybe we bring somebody over the top of them to maybe mentor and give them that skill set and experience of capital markets, M&A, that will position them for their next opportunity.
Yeah, I would agree, and I think, oftentimes private equity is kind of broad brushed as demons and villains, and we come in and we just chop costs and fire people, and that isn't the model of either Prairie or Winchurch. So if it's a good CFO, they have no reason to worry. In fact, we'd prefer that to be the case because there's institute knowledge that individual has. So we'd rather not change them out, but in the cases that we do, I think the writing's on the wall. I think they recognize that they may not have the skill set to take the business to the next level, particularly in a turnaround situation. So we will immediately begin the process. I've actually served as an interim CFO of 2 of our portfolio companies during the search period, which does 2 things. Number one, it makes sure that as the steward of our capital that we're kind of looking at the right way, but secondly, it can also assess the rest of the leadership team and where there may be changes necessary as well. So does that answer your question?
I know at Penray, I replaced the CFO, so we were bought in December of 2011, so 4 years ago, or 2010 rather, 4 years ago. And the CFO was nearing retirement age anyway, and the whole private equity, the whole reporting, the whole I guess level of activity was something that he just didn't want to do. And so, I was placed by the Overture Group there. I went over and talked to him. I'd come from another private equity firm, company that was just getting sold. But it was a great transition, because he was nearing retirement. We worked together for, a month before he left, and then he would come back, for another, 3 months, maybe like a week, a month before he finally, went into full retirement. But it was something that he just didn't want to do. It was a family-owned business, and he was comfortable with that. But he didn't want. He was 65. He was ready to retire, and it was a nice transition.
We're going to drill down deeper now. It's nice to say you want them to add value, you want them to dig into operations, we want to dig out costs. We want specific examples now, Tom. Okay, as well as others that you've seen in your respective CFOs, but we're going to start with Tom on this. Of how have you added value in your role as CFO? Give us some specific examples.
Okay, I'll give you some specific examples.
And then we're going to ask Patrick, and we're going to ask, we're going to ask everybody on the panel of examples of CFOs really adding value and that meet your expectations or exceed your expectations.
Yeah.
Tom?
I had an advantage in that I've been in the aerosol industry for 11 years. So when I got to Penray, I looked at the plant, and there was some manual processes that we were doing. We make aerosol products, we put valves in cans. It's a very tedious job, but we had people actually manually doing that. And this is something that my 2 prior aerosol companies didn't do. There is equipment that you can get that will eliminate that manual process. There's also something called a checkware that, on the back end of the line, that is an automated process. It should be an automated process. And things like drop packers. So I looked at the plant and said, look, we need to put CapEx into it. And, the returns were, between 30 and 40%. And we started taking people out of the process. And, for the most part, they were temporary employees, but the returns were pretty significant when you look at it and say, we're going to put, $500,000 to $1 million in CapEx into the plant, but we're going to take out, $200,000 to $300,000 of labor out of that. So, having seen that in other companies, it was easier to identify it at Penray, and so then you can say, okay, we're going to take this cost out. And there were a lot of things like that you would see at other companies that we could do at Penray. And then the other things I mentioned before, when we look at buying a company, is the key is identifying the synergy, and then what the cost is that you have, and then if you bolt on an acquisition, what cost are you going to have after you combine the companies? And being able to identify those synergies is something that we've done. Now, again, we haven't been successful in doing that in the last couple of years because we haven't actually bought any companies. But my prior company, the PLZ company, we actually did buy 2 companies, and we worked at what could we do to bolt on this acquisition. So we bought a company in Florida. We actually closed it down. We moved all the operations to our plant in Missouri, and we're able to take out costs because we didn't need a plant in Florida when we had such excess capacity at our plant in Michigan, or in Missouri rather. So it's just a matter of identifying these things, and some of it is industry specific, that if you've been in the industry for a number of years, you kind of know what to expect, and you walk through a plant and you can just identify costs that can be taken out. Or if you're going to buy a company, you know, and close it down, and you can take cost out and build that synergy. So there's some of the examples that in the last 5 years that I've had.
Patrick?
I'll talk about one portfolio company that we actually exited a little over a year ago, and we had a great management team in there. This was actually a carve-out situation. We bought it from a large publicly traded business. This was a small division, and we backed the team to buy the business back in 2007 and ended up selling it in 2012. And so they really had a great team in there, and specifically they had a great CFO. And really what made him great was he had a team underneath him, had a controller, and had staff. So it allowed him to really get his hands around the whole really operations of the business and drive value. I mean, he brought working capital down about $6 million over the course of kind of the first 2 years. So that was a kind of immediate influx of cash for us to kind of pay down our debt and provide us a little bit more flexibility on our balance sheet. And we had kind of a non-core small division that we wanted to get rid of. And the CFO ran the entire process from talking to the 4 interested strategic buyers that would buy it. It didn't warrant for us to kind of hire an investment bank and run kind of a big process, but this CFO ran the traps day to day on that, negotiated one heck of a deal in terms of cash today, and we also had kind of an earn-out piece that we got 100% of that earn-out. So he was involved on kind of that little exit piece of that division. And then lastly, when we exited this business, we sold it to a large publicly traded strategic buyer, and it was a very frothy process. And he presented very well in the management presentation, but you know, my experience as an investment banker dealing with strategic buyers, and sometimes when you present them an opportunity to either their executive team or their corporate development team, is they're good editors of strategy, sometimes they're not good creators of strategy, so you've got to give them and feed them the opportunity. And our CFO put together a wonderful case of how synergistic our business was to theirs, where the synergies were for them, and they came in and paid a 2-term premium for a very attractive asset for us and generated probably an incremental $30 million for all our shareholders. And so this CFO was really hands down one of the better ones we've worked with, of taking really a holistic view of how do we drive north, what Steve said earlier, on valuation. And so I know we're going to talk about compensating our CFOs, but aligning interests here. I mean, we want to back teams that are motivated, and we need to make a return for our investors, and we put our own capital in there. So how do we create a successful formula for that? Well, you incentivize the right people that are going to drive value for you, and the CFO is a critical person in that team. And that was a great example of him driving value for us and for him, because he was an equity owner.
That's a great example. Another one that kind of comes to mind actually is a fairly recent CFO hire that we had for one of our companies up in Alberta, Canada. It's an oil and gas company, electrical instrumentation, mechanical work, small, $75–80 million top line. But we knew we needed to top grade that position. The former CFO had been there for probably 4 years and was okay. One of the things we've realized, if you're satisfied with okay, you're going to get okay results, and so we needed to do better than that, so we top graded the position. Fortunate to find a guy that, when we hire CFOs, we got a very simple 2-dimensional grid. Do they get it, and do they get it done? And so you want somebody to top where they get it, the get it factor, and then they can also get it done. And this guy came in, and his first 30 to 60 days, he wasn't in the office. Where was he? He was out in the operations. He was in a truck riding around with these wrench turners out by the gas well, learning the business, learning where there's opportunities, creating an immediate relationship with the guys that he's going to have to work with. And he came back and he said, here's my plan. We got to put together a cross-functional team, sales, marketing, finance, operations, because we got a lot of challenges here. There's a lot of leaky buckets when he did his value stream mapping. And he put together a cross-functional team, again, recognizing that the relationship is 360 degrees. And they came up with solutions from, we weren't getting our bills out, we weren't signing tickets in time, and therefore we weren't getting our bills out in time, and therefore the customers were waiting to pay us, and we had 180 days from PO to cash, obviously not acceptable. So he went through every one of the cross-functional operational groups, and together they came up with a solution that, as Patrick said, saved us over $2 million on average in average working capital, obviously improved the P&L, but more importantly created this kind of this synergistic group between what was previously siloed organizations. So this CFO came in, he understood, he got it, he put the team together, came up with a solution, because we had a lot of issues up there, and really found a way to work together and understood where his value opportunity was in the value chain of the business. So great CFO, and he's only been there a year or so, and he's doing a great job.
Final perspective on that is, Rob, you're coming from a totally different angle again. When you see a CFO adding value, what are some of those areas, and they could have been overlapping with some of the ones that we've overheard, but where do you see as the outside auditor coming in where they're really adding value, and you can say, this is why they hired the CFO, this is what he needs to be doing?
Sure. And it's interesting, as I hear the panel talk, what we didn't really hear is while that CFO nailed the monthly internal financials and nailed all of that accounting and tax stuff, right? That's what I hear here. That CFO, when I look at a successful CFO, sometimes it's not really what you see until it goes very poorly. You're like, wow. So for me, I've seen really, really good CFOs integrate mergers, get hands-on, get in the field. Lately, I've seen a lot of my clients buy businesses internationally, abroad. And so it's not so much, oh yeah, we paid $14 million for some business in the UK or Taiwan, and yeah, they're out there, we have a controller, we get the financials, we plug them in. It's that CFO visits they're on the grounds, they understand the nuances, they integrate that business into the platform business, not just operationally, but also financially. If it might be a first-time foreign investment, what are the foreign currency risks? It's not just so much how you do the translation so you can do a balance sheet, but what are the risks? Should we evaluate a hedging strategy? So I see those CFOs really getting involved in merger integration, both financially, operationally, and from an IT point of view, so that things come together. So when it's time for Rob to come out and do the audit, or us to do the tax return, there really aren't surprises. So the private equity group owners don't get those surprises that Patrick mentioned earlier. Really things have to be aggressive in terms of getting in the field and integrating those add-ons.
Can I just mention one thing, because we talk about this super CFO, and we all might be thinking, uh-oh, I may not do that. One of the other keys to successful CFO is surround yourself with good people. So when I was a CFO, for example, I knew I wasn't the best on maybe the accounting side or the controller side, so I got the top-notch controller that I had, that I knew that side of the factory was well taken care of. And then on the other side, on the financial analysis side, I got the best financial planning analysis guy under me, so that I could surround myself, so that I could be more successful as that strategic partner. So I think it's critical that you understand that you've got to surround yourself with the best people under you, so that you can be successful in your role as CFO.
Which is what I did too. When I got to FEI, I had 4 people working directly for me, and in the first 6 months I replaced my controller, and then about a year and a half later I replaced another person, which was due in part to the new ERP system that we've implemented. But I knew pretty quickly that the staff that I had wasn't going to be able to do what we needed to do. And it wasn't mean-spirited or anything, but I knew that the guy who was the controller just wasn't cutting it, so I replaced him about 6 months after we did the acquisition.
That's an excellent point. We in our search program, we do a 6-month follow-up, and John knows what client I'm talking about. It's a private equity-owned client that we worked on, and this person got in there. He's a very good CFO. We've worked with him before, and he's not quite getting there. And he inherited an accounting department that has an actual longevity with this company of anywhere from 6 to 18 months. So a controller who's never been a controller before, an assistant controller who's like 6 months new, and he's working for an extremely demanding private equity firm. And I'm following up with him, but he is a nice guy, but he needs to start making decisions. Otherwise, he's going to be judged by his results, which are heavily driven by his team underneath him. But he's trying to give everybody the benefit of the doubt, and before you know it, you know, France is not going to give him the benefit of the doubt any longer, because the numbers just aren't getting there. So you're raising very good points. We talked about one subject, and I think it's a very interesting one, especially for me as a recruiter, but everybody in this office. The compensation packages too tend to be significantly different than what you see in private equity, or in a normal private firm. And not that they're all the same, but typically you see change of control agreements, typically you see long-term incentives, and let me just stop there. And we're going to ask primarily the two private equity firms, and Tom, we're not going to ask what your package is. We might ask what the attributes are. But
I can't wait to hear what they're going to say.
Yeah, and you don't have to.
No comment.
Take a lot of notes. Take a lot of notes.
We pay him a lot of money. Go to Capital South and tell him that.
And you can speak from your perspective of not just Prairie Capital, but when you were at Duffin Phelps, because I realize the gamut is all over the place, but there are some significant differences between what they do in private equity, or in private businesses. But Patrick, why don't you hit off with this question?
Yeah, I mean, when you look at kind of privately held businesses and CFOs, I mean, sometimes we see those CFOs overpaid, and sometimes we see them underpaid. It kind of depends on how generous that owner or set of owners are. But in our formula, and there's no formula per se for every portfolio company, but it's pretty simple. I mean, we try to align interest to drive kind of, I'm taking Steve's point, drive north to value creation, because that's what we're looking to do. When we underwrite a transaction, you know, we're trying to turn our dollar into $3 in 5 years. So we're looking for a 3x return on our investment. And so the team is highly critical in that. So when we typically get involved in a situation, the compensation, not only at the CFO, but kind of that executive team, it really consists of a current comp, which is what we believe to be fair market value. And then every year we set, you know, kind of our annual budget or forecast, and we drive to that budget that's based off of earnings or EBITDA, typically, depending on the business model, but typically EBITDA. And there's a bonus pool, and that bonus pool is allocated kind of among the team. So there's a current comp, there's a bonus. At the time of the transaction, we allow, you know, the right executives, not necessarily all members of the management team or kind of key people to invest, but the ones that we believe are going to be driving value for us, the opportunity to invest right alongside us in the same capital. So there's different variants of private equity firms out there. We provide the opportunity to invest on a pari passu basis on the same security as us for that management team member, and that includes the CFO. And then lastly, we typically have a 10% option pool. Sometimes it ratchets up to 15%, and that gets allocated to the team. Maybe not all allocated at close, because we maybe need to build out that team, and the CFO is part of that. So, you know, whether it's a 1% option or a 0.5% or 3%, it kind of depends on the situation, but the formula for our compensation typically is current comp, bonus program, hard dollars invested alongside us, and then kind of an option pool to really align the interests of that management team. And, you know, in some examples, that option pool can be worth millions and millions of dollars if they achieve, you know, above and beyond results, and we have a great successful exit. And so it's meaningful dollars for the entire management team, and then that really kind of creates continuity among the team to work together, to Steve's point of kind of that cross-functional of really driving value as a team.
Yeah, very similar. Again, everything's situational. There's no absolute, but generally our models are similar. We realize you get what you pay for, and so we don't succeed as owners or sponsors if the management teams don't succeed. So that alignment is absolutely critical, and we align ourselves similarly to Patrick. Obviously, we pay competitive, you know, salary. We've got the similar bonus pools. We set targets that are aggressive and attainable, and you can overperform, and we will overpay as well on the bonus. So very lucrative on the short-term piece. We too allow for co-investment on the front end, you know, pari passu at founder's cost for those who have the capability and the interest. That further gets, you know, ante in the game and sweat in the game. So we like when they do that. And then we too offer options as well, similar 10 to 15%. And if you think about it, that's where the real opportunity exists. I mean, we're all going to have to pay to get the best people. You have to pay, you know, the salary and the bonus that's competitive. But the real opportunity is that carrot. And part of what we try to do throughout the process, if we do dividend recaps, we want folks to be able to taste taste victory a bit. And so throughout the process, we allow them to take advantage through their options. There's a time-vested piece and a performance-vested piece, but to kind of taste the real prize which is out there when we sell this thing, and that's the real opportunity for CFOs, CEOs, and COOs. And similar to Patrick, I mean, it's a pool. We allow the CEO to kind of indicate who he suggests that we should allocate that pool to. But that's the big prize. So obviously on the short term and medium term, there's the competitive salary, benefits, etc. But the real opportunity, and this is what we want them focusing on, is the big prize at the end. We too have a three times cash on cash expectation. So people drive operating performance, and operating performance drives financial performance. A lot of people focus on the financial performance. We like to start with who drives it, and that's ultimately people, and CFOs are critical in that role.
We are in the process of closing a transaction and recruiting a CFO concurrently, and we had several candidates, and we had a candidate we liked a lot, and unfortunately we couldn't come to terms because he thought market was a 20% option for him on his equity, and we didn't know where he got his data, but we tried to be as transparent as we could. So I think having an understanding of kind of where market is, I think Steve's firm and Prairie are very consistent with where, from my banking days, most private equity firms are in terms of compensation of the CFO role and the executive team.
Yeah.
But just having an understanding of kind of where market is. I mean, similar to like owners, of understanding kind of where your value is, understanding kind of what the market would be for an opportunity is great.
Yeah, and on an average hold of 4 to 6 years, I mean, you can do the math. That can be very sizable, that 1, 2, 3% that you might be granted as a CFO. And so, in addition, presumably, many of the companies still have the defined contribution plans, 401ks, et cetera. So this isn't, that prize isn't in lieu of normal compensation. It's really to motivate and to align interests so that if you succeed, we succeed.
How about the employment agreement side, which goes hand in hand with a long-term incentive plan or any kind of option plans or bonus plans, in terms of severance from a double trigger point of view? I've seen some plans where they wouldn't get severance if there was a change of control and they lost their job. So you got the first trigger is we got a change of control. The second trigger is they lost their job within 12 or 18 months. But if their upside was above a certain amount, that would negate the severance. Do you have change of controls typically in your employment agreements, or do you prefer to emphasize the upside with the options, the long-term incentives, the bonuses?
Yeah, I mean, in our case, again, it depends. I hate to say that, but it's situational. I mean, generally, we have management agreements with the key folks, which are going to be CEO, CFO, and COO. But again, they have to be market-based. If they're not, you're not going to get the best candidate to serve that role. So it doesn't do us any good to make it so tight that from a change of control, we've got two components to that option pool. There's a time vested piece, which typically your options vest over 4 years, and there's a performance vested piece, and we set targets throughout the 4 to 6 year hold. But if we sell, all that is pulled forward, so you get 100% regardless of where you are in the vesting. The only severance issue is for cause or without cause, and usually it's hard to prove, as we all know, cause. So there's typically severance just built into those agreements, at least in our case.
Yeah, I would say it's consistent with us too.
I want to turn the questions at this point over to the audience because we've covered a lot of ground here in 15 minutes and we haven't opened it up to questions other than the ones that we had at the beginning. Other questions that you have of these gentlemen up here?
For Rob, on the goodwill change for private companies, what are you seeing in your clients? Are they going to 10-year amortization or leaving everything to roll the dice on another 2008, 2009, where they're writing off $20 million of goodwill at once?
About 70% of our clients are electing the private company counsel goodwill alternative, so that is real. They actually took the early election last year. Technically the gap's effective this year. There was an early adoption provision last year, so they did do that last year, and they started the 10-year clock last year. So I would say unless there is a strategy for an IPO or some sort of SEC registrant exit where PCC is not allowed, I would say generally those folks are making that election. Obviously it tremendously eases the burden of goodwill impairment testing, both inside the house, the business, and from an audit point of view.
And do the PE firms care because it's below the EBITDA line?
From my point of view, at least 70% of those clients, they don't care because it is just that. It is an add back. We have done some things in terms of financial reporting to just make it that much more apparent. You know, it's a separate line item on the income statement, goodwill amortization. It could be a supplemental schedule in the footnotes, such as a EBITDA reconciliation. So again, it's just there for any user of that financial to see why this year and not in 12, what happened. So we're trying to make it apparent.
I would agree. I mean, from our perspective, we're looking at the economics more than the accounting, so it really is less critical. And we're not typically exiting in a public market, right. So it's less critical for us.
Other questions?
You know, all my career has been private company CFO. What would I have to do to convince you guys that I can make that move to the PE side?
That's a good question, and I was going to say, if there's no other questions, what can you do, right, in terms of positioning yourself for an opportunity with a private equity fund if you haven't had that experience? And I'm sure a lot of you in the room are with a privately held business that has an owner or a set of owners that maybe are thinking about transition, maybe not. And you know, there's a huge market for kind of the aging baby boomer population to take some chips off or maybe look at exit alternatives. So, you know, I think of it from a standpoint of you can spend the time. So if you're in a situation where the owner's not selling today, but maybe thinking about it in 2 or 3 or 5 years, you can spend that time to really get educated on kind of the nuances of private equity. Spend some time with some private equity guys. I mean, we're constantly in the marketplace. Like I said, you know, 2/3 of the time we're bringing CFOs on to get a dialogue, ask questions, talk to other CFOs that are part of a private equity organization, and work to maybe surround yourself with the resources to maybe build out your team. So when it's time that you're going to exit, and whether that exit is through kind of a formal process where there's an investment bank that's going to kind of shepherd the universe of buyers through, and you're going to be on kind of display for management presentation, that's a great time for you to really get access to not only the ultimate buyer, but also get introduced to a bunch of other private equity funds. And I can tell you that when we go to a management presentation and we find a good team, we're really impressed with them, and we keep in touch with those gentlemen, those individuals. And then the other thing I would say is, you know, during the diligence process, that's really your time to shine, because you are going to be interacting with that buyer. So understanding what that diligence process consists of and making it as seamless as possible puts you in a good spot.
Yeah, I mean, from our perspective, whether it's a private company or a public company, it's kind of irrelevant. I mean, it's really, again, do you come with that skill set and that tool chest that's going to make you successful in the role? And so a lot of that, when we're interviewing candidates, it's share with the people you're talking to the how behind the what. Everybody says the right things in interview. Everybody's resumes all say the same thing, and we're all, you know, that's less critical. It's share with the how, and how you get things done, and how you drive change, and how you change behavior, and how you work with organizations within the bigger organization. That's really what we're looking for. So it's less about whether you're small or mid-size or private or public. It's more, do you have that tool chest that's going to make you successful in this role? Because the reality is, you know, it's got to be a fit both ways, right? It's got to be not just good for the hiring company, but for the individual as well. And if you're coming in the wrong situation, that's not good for anybody.
Barry, you talked about the dynamics when the portfolio company is going south, and you know, that makes it even more interesting in relationship with the CFO and the management that's trying to protect their jobs, and the PE firm that's trying to assess the situation. I was brought on as a CFO in a replacement CFO in a turnaround situation for a pharmaceutical firm, and very, very interesting dynamics there, including especially at the tail end when I knew that the private equity firm was going to replace the CEO and the COO, and just trying to hold things together without everything kind of blowing up.
Great question. You know, the skill sets in that situation may be different. You know, so the CFO managing at various points of the S-curve, that's the one that's on the downside and struggling. And so I guess the question is, do you have the skill sets that are consistent with that turnaround? And you know, I don't think we impart different expectations, but we do set expectations wherever you are on that S-curve. And in that situation, it's really making sure that you understand what matters. It's all about cash. you got to have 13-week cash flows. It's less about 3-year strategy and 1-year budgets. Can you pay payroll next week? And what are your vendors going to say if you don't pay them? And how quickly can you collect cash? So in that scenario, what we look for is, do you have the skill sets that are more consistent with a turnaround situation? And they are different than those that are in high growth rates, very different.
The private equity guys don't want to hear that you can't meet next week's payroll. And I heard that from our private equity guys with other portfolio companies, and it was only about a month or so ago. And you know, that's something we monitor every day. You know, what is our availability? You know, so we don't have bad surprises. But I know it happened with one of our other private equity companies, private equity owned companies, where you know they were short on payroll and they actually had to transfer money to meet payroll. That's where you don't want to be.
But the interesting thing is you shouldn't be there. If you have a vision of the future and a 13-week cash flow, you shouldn't be there if you're the right CFO, because it's not a sudden event. It doesn't just happen, right? It's a process. And so that's why we always look for, particularly in situations, about a third of our portfolio we buy out of bankruptcy. So we understand that skill set you just described, more on the front end than perhaps on the back end. And so I'm always amazed when I get that call, we ran out of cash. Well, first of all, we shouldn't, because I should be looking at it anyway already. But secondly, if you have a 13-week cash flow, I'm not sure how you get there.
Yeah, in situations like that, you know, we've made 83 investments. I can't say that we've never had one kind of hiccup. We have, and you know, you try to get to the kind of root of the problem, whether it's a sales side or it's a cost side in terms of what's driving that kind of spiral down. But if we've got a solid CFO in there, that's the last person we want to change. And that's a critical role for us, and cash is king. And so, you know, bringing in even an interim consultant in, or people that we've worked with in the past, is a secondary thing. We have to assess whether that individual has a skill set for it, but it's not a situation where we're going to make a wholesale change at all. And a lot of those times, even if it's a situation where maybe we've lost our equity and we're working for the banks and we're trying to do the right thing, and there's really not a lot of quote upside for that CFO, we have a lot of loyalty to that CFO. That CFO becomes kind of an anchor for us for our next opportunity and our opportunity where they can go into a next deal.
Well, I want to thank the panelists.
One more.
Oh, one more, and then what we'll do is the panelists will be available after we thank them. But we'll have one more question. So
I just want to expand on Dan's question about transitioning from a family-owned or non-PE-owned company. Having gone through the transition and experiencing that situation, you guys mentioned a lot of the points of what you guys are looking for in a CFO, and I think the challenge is that as you make that transition is that communication, that dotted line, solid line, which one is it? I think that's important in learning, and I think the other thing is you mentioned a lot of the things of it's important to make that transition from that numbers guy, the guy who, to that operations guy who's out there trying to find things to change and to add value. And I just wanted to expand from a real life experience as to those are really important. I think that's the challenge, not so much the challenge of getting in, but once you're in, it's making that transition.
Yeah, I would agree. And so what we do is we set that expectation up front about that reporting, for example. So we work with the CEO and make sure he understands. Yeah, there's a direct report to you, but if at any point in time we need to or want to, or he wants to call us with an issue, that opportunity exists. So set that expectation up front, because you don't want to undermine the CEO. Clearly that's not the thing. So I think the key there is set expectations that are clearly understood. And then the second piece, yeah, the transition is, it's challenging, but it also starts with setting clear expectations. What do we expect of the CFO of that organization? And if we're doing our job, those expectations are clear, they're clearly communicated, they're documented, and then we track them along the way. And so we will see, as will you, if there's a problem, and we ask you raise your hand and come with counter solutions, or countermeasures and countermeasures. Be proactive as opposed to reactive. Don't make the call, there's a problem. See it in advance that there will be a problem, and here's our plans to fix it. And so that's what we look for in terms of that transition.
I want to thank the panel this morning.